All right, let's just jump right into it. We're going to talk about something that makes even the most experienced crypto folks a little nervous, a big market crash. But what if we've been looking at it all wrong? What if that fear is actually a signal for a massive opportunity? That's what this is all about, how to find that blockchain bargain and scoop up amazing projects when they're basically on sale.
You know the feeling, right? You pull up your portfolio and it's just a sea of red. Your stomach just sinks. And the first instinct, the human instinct, is to panic. To think, oh no, it's all over. It really feels like a total market meltdown.
But hold on. What if that's completely the wrong frame of mind? What if that sea of red isn't a meltdown at all, but a giant flashing clearance sign? This is the mental flip we need to make. Seeing a crash not as the end of the world, but as a blockchain bargain sale for anyone who knows what they're looking for.
So, okay, how do you actually do that? Well, it all comes down to mastering something we call the art of the dip. And look, this isn't about gambling. It's not about just throwing money at something falling and hoping for the best. No, it's a real strategy for turning that widespread panic you see online into your own personal strategic advantage.
Because buying the dip is so much more than just a funny meme on Twitter. When you do it right, it's a super disciplined strategy. It means you've learned to tune out all the noise and the panic, and instead, you focus like a laser on what a project actually does. Its real, fundamental value, its intrinsic utility.
And really, it all boils down to two completely different mindsets. On one side, you've got your emotional, reactive investor. They're chasing hype, they're panicking on the dips, they're only thinking about the next 24 hours. But on the other side, you've got the strategic investor. They're disciplined, they're thinking years down the line, and they've done their homework. That is the side you want to be on.
And that homework, that due diligence, it's all about one simple idea: choosing fundamentals over fads. It's learning how to see through the temporary hype and spot the projects that are actually built like a brick house, the ones that are designed to last.
So what do these fundamentals even look like? Well, here are four huge things to look for. First, is there a big, active community of developers who are constantly working on this thing, making it better? Second, is anyone actually using it in the real world? Is it solving a real problem? Third, is the technology itself actually good? Is it fast? Is it secure? And finally, do they have a clear plan for the future, a roadmap, and are they hitting their goals? These are like the vital signs of a healthy project.
Okay, so now we've got the right mindset and we know what metrics to look for. So where do we start looking? Let's put together a little crypto shopping list. We're going to focus on 5 specific categories that are basically the essential pillars of the entire future digital economy.
These 5 areas, they're not just random picks. They're the absolute bedrock of the crypto world. Think of them as the digital highways, the new banking system, the data careers, the international bridges, and the stock exchanges of this whole new economy. Let's break them down.
First on our list, smart contract platforms. These are the big ones, the foundational blockchains, like Ethereum or its competitors. The best way to think of them is like digital real estate. They are the ground upon which every other decentralized app, or dApp, gets built. And the best ones are always getting faster and cheaper to use.
And right there, that's the opportunity. When the price of one of these major platforms takes a hit, it's almost always just a market overreaction. It's not because the technology suddenly got worse. So you're not just buying a token, you're getting a discount on a piece of essential digital infrastructure. It's like buying land in a growing city during a temporary downturn.
Next up, number 2, DeFi protocols. That's decentralized finance. This is the whole new financial system being built on top of those platforms we just talked about. These are the tools that let you do things like lend, borrow, and trade, but without needing a bank or a broker in the middle. They're the financial plumbing for this new world.
And you got to remember this. Just because the token price is down doesn't mean the protocol stopped working. Not at all. There are still millions, sometimes billions of dollars flowing through these systems every single day. A price dip just means you get to own a piece of that financial plumbing for a heck of a lot cheaper.
All right, category 3 is a big one that a lot of people miss: decentralized oracles. This is such a critical piece of the puzzle. Think of an oracle as a secure messenger that brings real-world information, like say the price of gold or the score of a baseball game, onto the blockchain so that smart contracts can actually use it.
And that quote says it all. Without oracles feeding them good, trustworthy data, smart contracts are completely blind. They're just code floating in a void, unable to interact with anything real. This tech is absolutely 100% necessary for the whole system to work, which makes these projects an incredible fundamental investment.
Number 4 on our shopping list is cross-chain interoperability. So right now, most blockchains are kind of like their own little isolated islands. They can't easily talk to each other. Interoperability projects are the ones building the bridges and the tunnels that connect all these islands, letting them share information and value. The goal? One giant, unified digital economy.
And that's the long-term play here. The future isn't going to be just one blockchain that wins everything. No way. It's going to be thousands of different chains all working together. So buying into these bridge projects during a dip is a bet on that interconnected future. A price drop is a short-term gift for sure.
And last but not least, our 5th category, exchange utility tokens. These are the native tokens of the big, centralized crypto exchanges where most people trade. Their value is directly connected to the success of that exchange's business. We're talking millions of users, huge trading volumes, and all the services they offer.
And that's what makes them so strong. Think about it. As long as people are buying and selling crypto, which they are, even when prices are down, these exchanges are making money. That real-world revenue supports the value of their tokens. It's a bet on the core plumbing of the market itself.
So when you put all this together, the mindset, the metrics, the categories, it all points to one single incredibly powerful idea. This should be your mantra as a long-term investor in this space. Price follows utility. So here's the real secret to buying the dip. A market crash is like a huge wave that comes and washes away all the junk, all the hype projects, all the fads, all the things with no real value. Your job, as a smart investor, is to learn how to tell the difference between that floating debris and the solid heavy infrastructure that's just been temporarily put on sale.
And if you take only one thing away from all of this, let it be this: price follows utility. Hype dies down, speculation fades, but things that have real, actual use in the world, things people need, that is what lasts. And projects with great utility, they always bounce back.
Because listen, you can be sure of one thing. The next dip is coming. It's not a question of if, it's just a question of when. So the real question you have to ask yourself is, when it gets here, what are you going to see? Will you just see the panic and the debris being washed away, or will you be able to spot the diamonds?